Welcome to the Don't Pay Retail podcast, brought to you by Ty Keller with TyClosesLoans.com, where we pull back the curtain on how mortgages actually work so you stop overpaying for yours.
Welcome to today's deep dive. Imagine bleeding thousands of dollars over the next decade just because you picked your mortgage based on, like, a high school style label.
Yeah, I mean, it sounds crazy, but it happens all the time.
That's right. And if you're a first-time or move-up home buyer in North Atlanta, Cumming, Forsyth County, Canton, Woodstock, or really anywhere across Georgia, Florida, Colorado, and the Carolinas, you need to hear this.
Absolutely, because so many buyers just get completely paralyzed by the FHA versus conventional loan dilemma.
And they base their choice on this totally toxic myth. I mean, we're looking at notes today from Ty Keller, who's an 18-year wholesale mortgage broker, right?
Right, and he sees buyers walk in every single day thinking FHA is like the misfit loan for bad credit.
Oh, and that conventional is the VIP table for the wealthy buyers.
Exactly. They treat these loans like social clicks, which is just a massive financial trap.
Because, practically speaking, those labels mean absolutely nothing to your bank account. The real battleground isn't the name of the loan.
No, it's not. It's really all about the hidden mechanics of the mortgage insurance. That is the real divider here.
Okay, so let's break that down. Because with conventional loans, you have private mortgage insurance, or PMI, right?
Yeah, PMI. And that's tied heavily to your credit score and your down payment, which, by the way, you can get in for as little as 3% down if you're a qualified first-time buyer.
Wait, really? Just 3%?
Yep, just 3%. But the defining feature of that PMI is that it's temporary.
Oh, like training wheels on a bike. You need them to get rolling when your equity is low.
Exactly. And once you hit 78% equity, those training wheels automatically fall off.
Or I guess you can proactively ask to have them removed at 80%, right?
It's just a phase. But FHA mortgage insurance, which is called MIP, behaves completely differently.
How so?
Well, first, there's a 1.75% upfront fee. And then if you put down less than 10%, which is, pretty standard for most FHA buyers, that monthly insurance premium is just bolted to the frame.
Bolted on? Like, for how long?
It stays for the entire 30-year life of the loan.
Whoa. Wait, so if conventional PMI naturally falls off and FHA insurance is permanently bolted on, why would anyone ever voluntarily choose FHA?
I know. I mean, on paper, a permanent penalty sounds terrible.
Mm-hmm.
But it really comes down to access.
Okay, access how?
Well, because FHA is incredibly forgiving, they use government risk pooling, so they allow a 3.5% down payment with credit scores dipping down to like 580.
Oh, wow. And conventional won't touch that.
Exactly. Conventional usually won't touch a 580. So for someone with rougher credit or a very thin down payment, FHA is just the tool to get you in the door.
I see. So you use it to get the house, build equity, and then you just refinance out of it later.
That's the playbook. Strong credit favors conventional because the insurance drops off. Rougher credit favors FHA as a stepping stone.
That seems fairly logical, but I see buyers completely ignoring this structure just to agonize over like a fraction of a percent on the headline interest rate.
Oh, yeah. The way Ty explains it, that's called the total cost trap.
The total cost trap. I like that.
Yeah, I mean, the headline rate is the boldest number on the page, so it naturally grabs your attention. But a true comparison demands looking at the interest rate, plus the mortgage insurance, plus how long you'll actually hold the loan.
So a conventional loan might show a slightly higher headline rate than an FHA loan, but actually cost thousands less over the long haul.
Exactly, because its insurance is cheaper and eventually vanishes.
But the problem is, trying to uncover that true total cost feels impossible if you're just walking into a standard retail bank.
Right, because you just get their single rate sheet, and that's it.
It doesn't tell the whole story.
Not at all. Which is where Ty's wholesale approach really flips the script. When you use a wholesale broker, you aren't tied to one bank's strict internal rules.
Right, because they shop around for you.
Exactly. Just one single application forces over 110 lenders to compete for your loan.
110. That is a massive structural difference.
Huge. PMI pricing varies wildly from lender to lender.
Oh, so while a retail bank might just push you into an FHA loan because it fits their narrow guidelines.
Yeah. A broker uses that competition to uncover a specific lender where your unique credit tier makes a conventional loan surprisingly cheaper than FHA.
That makes so much sense. You really can't blindly lock yourself into the just go FHA or just go conventional camps.
No, you can't.
Yeah.
You need someone to run the full competitive numbers for your specific situation.
Right.
And here is a final provocative variable for you to mull over.
Oh, lay it on me.
How many years do you actually plan to stay in the home?
Oh, because that changes the math.
Completely. It's a non-financial detail that changes everything. If you're moving in 3 years, a life of loan FHA insurance premium might not matter at all.
Right, because you're out before it adds up. But if you're planting roots for 20 years...
then that permanent premium changes the winner entirely.
Wow, yeah, so don't let an arbitrary label or a misleading headline rate trap you in the wrong mortgage.
Break out of the clicks and get the math right.
Get started at TyClosesLoans.com.